Wanting to get a job in investment banking but still have no idea what it is? Well, you're not alone. It's true that many people don't like bankers, yet many still want to be bankers. Why? Because $135,000 is the staggering salary of an entry-level banker, and $103 billion is the net worth of the investment banking global market in 2020. But with the good comes the bad. Being a banker means grueling workload and long, sleepless nights. During peak time, 100-hour work weeks is not unusual. So, what is investment banking, and what do you need to know to get that lucrative job? The history of investment banking. What gave birth to the rise of investment banking? To truly understand investment banking, let's turn back the clock to explore how it all began. Investment banking went all the way back to the medieval times. Most of the oldest investment banks began as merchants trading commodities on their own account. Gradually, they grew out of family confines to take on limited liability partners, lending to a range of monarchs, royalty, and the papacy to gain privileges, access, and side payments in return. The Rothschild family is one example of the success of such merchant banks. Then came investment banking's golden age, as the merchant banks evolve into modern form with the development of underwriting and sale of government bonds. Expensive military engagement drove the government's financing demand. They knew they needed to sell bonds, but lack of expertise to assess bonds led them to become investment banking's largest clients. When World War I hit, a large proportion of investment banking was universal or mixed financial institutions of some sort. By the 1960s, however, financial institutions started expanding and combining into financial conglomerates. Over the latter decades, new kinds of business like securitization and derivatives and new varieties of financial institutions like venture capitals and hedge funds emerged, providing lucrative returns for investment banks. But then, the 2008 global financial crisis hit, resulting in the shocking failure of too big-to-fail investment banks like Lehman Brothers and AIG. U.S. banks remained, after the crisis, converted to financial holding companies to access greater range of funding sources and Federal Reserve's discount window, while many troubled ones were merged into healthier ones or forced into liquidation. This gave birth to today's form of investment banks as global financial conglomerates with big names like HSBC, JP Morgan, or Bank of America. Very few of the long-established banks like Goldman Sachs and Morgan Stanley remained pure investment banks. How are investment banks different from commercial banks? So, we know that investment bankers are high-risk-taking middlemen between clients and investors, and commercial banks are different from investment banks. Does this mean that commercial banks don't take risks? Of course not. Commercial banks serve different types of customers and take different kinds of risk. They serve individual customers and small businesses in their physical branches and online channels with checking and savings accounts, mortgages, auto loans, and safe deposit boxes. They take deposits and provide checking and savings account services, then use the money to provide loans and mortgages, making money off the interest they charge. They tend to be on the safe side, investing their capital only in customers or businesses with good credit history and sound business models. Investment banks, on the flip side, tend to deal with larger or more sophisticated organizations with more complex funding needs, helping corporations with the purchase and sale of bonds and stocks, the negotiating of mergers and acquisitions, and the issuance of IPOs. The key idea is that investment banks don't directly lend or invest in the clients, they stay in the middle. Another big difference between two types of banks lies in regulation. Commercial banks are heavily regulated by several government entities, while investment banks are only regulated by the SEC, the Securities and Exchange Commission. This means that commercial banks have an implicit duty to act in their clients' best interests, while investment banks have a significantly higher degree of freedom in their operations. Yet, this type of freedom contributed greatly to the 1929 stock market crash and the 2008 global financial crisis, earning the industry a bad reputation. Given such a bad history, more regulations are being imposed as a safety handle for the industry's operations, with many more to come. What do investment bankers do? We have learned enough of the history of investment banking and its difference. It's time to dig a bit deeper into the work of an investment banker. A real investment banker works in the front office, which comprises mainly of 4 divisions: investment banking, sales and trading, asset management, and research. In fact, people can work at an investment bank but are not real investment bankers because investment banks, like any other big corporation, need middle office to take care of risk management and treasury, and back office to take care of accounting, IT, etc. The core of today's investment banks is the investment banking division, dealing with underwriting debt and equity and advisory. Not only because this is how investment banks started, but also because this division adds the most value to the bank. This division is often misunderstood since many people think that investment banking and investment bank refer to the same thing. Yet, history has shown that investment banks have evolved to include more than just investment banking. This is just a service division within an investment bank, but an important one. For simple classification, the investment banking division can either be divided as product groups or as industry groups. If you do it the product groups way, then the investment banking division typically performs specific deal types like mergers and acquisitions and financing or capital market for all industries. In an M&A deal, the division assists in selling a company or acquiring a company. In a financing or capital market deal, the division advises on the client's most complex strategic needs for capitals. A company capitals consist of both equity and debt, and the division will advise on both, typically referred to as equity capital market and debt capital market, respectively. If you do it the industry groups way, then the investment banking division performs all deal types for a specific industry: technology, healthcare, real estate, transportation, natural resources, etc. You name it. Moving on, we have sales and trading division. This division, as the name suggests, has the sales side and the trading side. The division collaborates closely with the investment banking division to advise clients on trading securities and distribute securities to potential investors. Salespeople do what they usually do: building relationships with clients and pitching ideas to them. Trading people, meanwhile, make the market and execute the orders for clients. In essence, sales and trading division is the matchmaker, matching promising buyers, such as investment funds, with companies issuing stocks and bonds. Asset management division is even easier to understand. They manage the investments on behalf of investors or provide investment products to institutional and individual investors. They can act on behalf of investors because they have the expertise. So, where does the expertise come from? It comes a lot from the research division, also called equity research. This division analyzes public companies, speaks with management teams and investors, and makes buy, sell, and hold recommendations on the stocks. Investment banking careers overview. What are your chances? The most prestigious jobs are always those of investment banking division, typically called Tier 1. Sales and trading, equity research, and other divisions are in Tier 2 with less exit opportunity. Pathways to investment banking varies depending on the individual's background and experience. But the common ones distinguish among the undergraduates, graduates, and working professionals. For undergraduates, you need to start very early to break into top investment banks. Freshmen, decide if investment banking is for you. Start networking with bankers and taking some accounting and finance classes. Sophomores, complete finance-related internships over the 2 summers to prepare for IB recruiting. Relevant internships can be secured at boutique PE or VC firms, startup hedge funds, Big 4 firms, or corporate banking. Juniors, continue networking with bankers and prep for interviews. You are likely to receive interview invitations during the fall semester of your junior year and hear back around the end of the semester. Once you have an internship at an investment bank, it's easier to secure a full-time offer for a 1B analyst position. If you start your investment banking preparation later than sophomore year, it might be difficult to get the Tier 1 roles in 1B division. Yet, with smart networking and selling relevant banking experience on your resume and interview, you still have a good chance of getting a Tier 2 internship, sales and trading, or asset management. What about MBA students? Are you in the top 20 MBA programs? If yes, congratulations. You have a decent chance of getting both a Tier 1 and Tier 2 careers. The key is to grab a summer associate internship right after your first year of MBA. What if I'm not in the top 20? Do I have any chance? Of course you have. It just takes a crazy amount of networking and strong finance-related work experience to get the job. It's hard, I know, but you can do it. The key for MBA students is to leverage the school alumni network even before enrolling in classes. Remember, it's never too early for networking with dozens of bankers to get good insight and referrals for internship interviews. Let's talk about professionals working in other industries. Professionals certainly don't go the internship way. You break into the bank with relevant work experience. The earlier the better, say 1 to 2 years after graduation. If you're working in deal or finance related roles at the Big Four accounting, corporate development, or valuation firms, your choice is higher. Over the past years, big banks have offered many slots to experienced professionals through special recruiting programs as a way of diversifying the workforce. And the key to success? You know it, networking. Exit opportunities. One of the most appealing aspects of investment banking jobs is excellent exit opportunities. Private equity, hedge fund, and corporate development are the most popular paths to exit. Among those, the most favorable one is private equity. Thanks to its handsome compensation and slightly better working hours than staying at 1B, yet it's quite competitive and favors bulge bracket banks, analysts with M&A deal experience. The best bet is to join the on-cycle process, which invites fresh bankers to apply a few months into their first analyst year. Hedge fund, on the other hand, is more niche in terms of recruiting process, skills required, and pathways. Hedge fund analysts are usually part of a smaller team to invest billions of dollars, thus it can be extremely lucrative, but also fairly high stakes and stressful. This exit opportunity is better for those with passion and a track record of investing. For analyst positions at fundamental-based hedge funds, you will need to demonstrate excellent technical skills and the ability to generate investment ideas based on your analysis. Lastly, we have corporate development. The role handles M&A and joint venture deals for a big company. Your skills and knowledge at 1B are totally applicable. If you prefer a better lifestyle with decent but lower pay than private equity, corporate development is a solid option. Now that you know what investment banking is, it's time to kickstart this career. Go to bankingprep.com to find answers to any other questions you have about investment banking. We have in-depth guides and prep materials to help you land the job. If you find this video helpful, don't forget to like and subscribe to our channel, leave a comment down below, and if you have any questions or suggestions for our next video, thanks for watching.